Welcome to Chapter 9, headed down the home stretch here. And in this chapter, we're going to talk about payroll from the employer side of things. So in addition to the employer making sure that they're properly withholding for federal, FICA, any state taxes, any voluntary deductions, the employer also has some financial obligations when it comes to payroll. There is a matching part of the FICA, so the employer also has an obligation for Social Security and Medicare. Additionally, there is federal unemployment and state unemployment, which is often, avoiding these costs are often why employers try and sort of skirt the issue sometimes, and I won't say often, but it is a motivating factor in why employers want to consider somebody an independent contractor as opposed to an employee. Because if they're an independent contractor, the employer escapes all of this. However, if they're not truly an independent contractor and the employers just called them that, the consequences are quite expensive because they want to deter people from doing that. So as I said, both the employer and the employee each pay 6.2% of Social Security. And so the last column here, and we'll go over to the other, this page is sort of, look at it like it's a spreadsheet split down the middle. So we've got our Social Security that are with the employer obligation of things. And then we've got the employee side, federal, Social Security, Medicare, health insurance, United Way, all of that. So again, these are not deducted from the employee's paycheck. These are costs over and above paying your employee that the employer is required to pay. Now, what happens if you do, in fact, have that independent contractor? Well, if that doesn't, the fact that you're not withholding tax from them doesn't mean that they are not taxed on their earnings. They're just taxed differently. So anyone who earns more than $400 from you, unless it's a company, but I mean, if it's an individual and you're paying them on a contract basis or even just a casual sort of one-off basis, more than $400, you are required to give them a Form 1099 at the end of the year. Your employees will get a W-2, the independent contractors will get the 1099. And unless the person tells you specifically, there's no obligation to withhold taxes on the 1099. As I said before, there is also federal unemployment. This is actually not terribly painful. So it is 6% up to the maximum earnings of $7,000. What that comes out to effectively is $42 a year per employee that earns at least $7,000 a year. That's generally just due once a year unless you have a big whopping payroll, but for most small employers, they can just send what's called a FUTA return. It's tax form 940 with the payment. So I send them my $42 every January with the form 940. Now, there is also state unemployment. And so there is sort of a credit, but mostly you don't have to worry so much about that, about how the interplay between the state and the Fed. All you really need to worry about is if you apply 0.6 as the multiplier on the wages, and then the rest gets credited to the state, assuming there's state unemployment, and I don't know a state that doesn't have unemployment. Effectively, it is 0.6%. Now, with state unemployment, and I will stop for a second and hop over. All right, so here is an example of a state of Vermont rate notice, and I cut off the top part because it has actual numbers on it, but this gives you an idea of what the what's called an experience rating is. So an employer that has no, and when they say experience rating, how many of your employees have filed unemployment claims? And this is there's a ratio calculation, and the more employees that you have file unemployment claims, the higher the percentage that you pay. So you'll see the lowest percentage is 0.8%, but that goes all the way up to 6.5%. And this is one of the reasons that employers tend to challenge, unless it's truly legitimate, the unemployment claims of their employees, because it is not just a no harm, no foul, I'll let somebody take unemployment. This is going to cost the employer real money at some later point, usually the next the next year. These things in Vermont, they come out July 1, or they're effective July 1, so I usually get them sometime late in the spring. And so, yeah, in the middle of the calendar year, the unemployment percentage could change. So you have to pay attention to this calculation notice when it comes, to make sure that you're not inadvertently paying for the rest of the calendar year on the old rate for the first half of the year. But anyway, so this is what one of those notices will look like. So the calculation of payroll tax from the employer side is a bit easier. Basically, you're just taking the gross earnings and you multiply that times the Social Security, or times the tax rate, whether it's Social Security, Medicare, or unemployment, and that's how you determine the rate. Now, again, FUTA and state unemployment and the employee side of Medicare and Social Security are not deducted from the employee's paycheck. So on a payroll and there are some items that may be subject to, again, if the Social Security but not Medicare, which is why the amounts may be different. But again, this could be, a fair amount of money for an employer to have to pay. And so we need to do this journal entry too, because we need to then, from an accounting standpoint, account for the money that we're paying. So we're going to have an expense for the payroll, and until we actually pay it, we're going to have a liability. So here is the full payroll expense for the taxes, I should say payroll tax expense, and then here it is broken down in all of the additional, all of the discrete payable categories. And yes, you do need to break it down by individual categories, because for the most part, this is all going to different places. So Social Security and Medicare are going to get remitted depending on the size of your payroll. Could be every third day, could be once a month, could be once a quarter. So you got to know the rules around that. FUTA it goes to the federal government, but it goes separately from Social Security and Medicare. And then state unemployment goes to the state. So you want to make sure that you keep these broken down separately in your payroll journal. And here it is from a T account perspective. And then again, we've got the payroll tax expense, and then we create payables until we actually send the money off to the taxing authority. So it is a credit to the payable account, and then when we actually send it, we debit the liability account, and then we credit cash. Again, here is total cost of an employee. And often, when an employee thinks about what they make and what they cost their employer, they're only thinking about their side of it. So here the employee thinks, okay, well, I cost my employer $26,000 a year. But in fact, it's really closer to 28,000. And if the employer is paying some portion of health insurance or retirement or things like that, the cost could be substantially more than that. And so I think sometimes employees forget that, what their actually true cost is. So areas of responsibility, making sure that federal income tax, Social Security, and Medicare are withheld, that FUTA and SUTA taxes are paid, that you give your employees their W-2 at the end of the year. All the W-2s, not only do they get sent to the employee, but they get sent to the Social Security Administration, and that's where they go. And they go with what's called a Form W-3, which is a transmittal form. It's like the cover sheet that says how many total W-2s you're sending, what the total amounts are for gross wages, things like that. And so now the government's got a copy of what you paid people. So now when they file their taxes, if they don't report, the government knows what to expect in terms of what they're going to file on their income tax return, and they will match those. And if they don't match, the taxpayer will be in trouble. There's also a form called an I-9 where you have to verify basically the ability to legally work in the US. There are also state forms that you may have to complete for like new hire obligations that provide sort of early alerts to child support agencies. So as I've mentioned, making sure that you know when your payments are due and whether you pay them electronically or, and they talk about payroll tax deposits. And I used to, let me just pause this here. Found it. So this is a coupon book, and this is how payments used to get made. You would tear a coupon out of the book, you would bubble in the tax form and the period, and then you would take this coupon along with the payment to any federally insured depository institution, i.e. a bank, and the bank would take this money, they would give you a little receipt, and you pray like crazy that the bank doesn't screw up and that your money actually ends up with the federal government. So no more of those. I'm actually surprised. I was cleaning out my desk and I found one of those and thought, what a great prop for a lecture. So I hung on to it. But now basically, if you have a little bit due with the return, the 941 return, you can send the money with the return. Otherwise, you're obligated to pay electronically. And again, how often it's due depends on the size of your payroll. I won't read this slide, but you can pause it here and read that. And again, the frequency of these deposits is determined by the lookback period. So as I said, I had the coupon book, which is, they still use the term tax deposits, even though you don't use the coupon book, and really it's just an electronic funds transfer that gets made, direct debit out of the bank account. So when the tax actually gets paid, you're going to debit those liabilities and you're going to credit your cash. You've got to make sure that you file Form 941, which is the form that accounts for the Social Security, both employee and employer, Medicare, both employee and employer, as well as any federal withholding. So all three of those taxes are captured on one return that's filed quarterly, April 30th, July 31st, October 31st, and January 31st. And they will penalize you if they were late, even if there's no tax due. So you get a penalty for just filing the form late if you're not careful. So mark your calendar for those. This is a slightly older form. Well, again, the form varies based on what Congress has decided to do. So there were CARES Act forms that changed as a result of those issues. And but I think this is mostly self-explanatory. Again, if you have software, it will just spit this form out. If you're calculating this manually, your four-function calculator is all you really need to correctly calculate this form. Make sure to sign it and date it, and off it goes. Now, when you go to make your FUTA, if you have less than $500 a year in federal unemployment, then you can avoid having to make quarterly payments on that, and you can just pay it at the end of the year. But if it goes over $500, then you have to deposit at that point. So again, at $42 a year per employee per employee that works $7,000 per more a year, depending on the size of your payroll, you may or may not run into that $500 or more situation. But Form 940 is what the FUTA is reported on at the end of the year. It's actually January 31 of the following year. And make sure that all of your deposits have been made. And this is what the FUTA form looks like. Again, nothing particularly mind-bending about that, just your basic math, but make sure you date it and sign it and timely file it. Now we get to the state, and the state does in fact want their money, their unemployment quarterly. And so when we pay the SUTA over to the state, you're going to debit your payable account and credit your cash. And the forms vary widely by state, so we're not going to go into them here. Again, W-2 at the end of the year, it's a multi-copy form, and it says here which copies go to which individual. Basically, you're going to give the employer copies C and 2. And so, or B, I should say B, C, and 2. So B is what the employee is going to, if they choose to paper file, although hardly anyone does anymore. So copy B and copy 2 would go to the state or federal respectively with any paper filed return. Anything filing electronically, they don't send the W-2s in. Because the government just electronically matches that up with the copy that the employer sent. And then copy C is for the employee's records. Oh, I should say copy A is what goes with that Form W-3 transmittal form to the Social Security. And I assume at this point you all know what a W-2 is, but you can feel free to pause this. I'm not going to spend a lot of time going over that. And as I said, copy A goes to the Social Security Administration, and it goes with that Form W-3 transmittal, which is like the cover sheet for all of your whole company's W-2 forms for that particular year. And here's what that looks like. And then you do your grand total of all of the money reported on all the W-2s you're sending on the face of the Form W-3. And the I-9 form isn't something that you have to file, but an employer is obligated to complete it and require that certain proof of identification and proof of ability to work in the U.S. be produced. Otherwise, they cannot hire this individual. And lastly, workers' compensation. Super important. Your company will pay workers' compensation based on the nature of the work the employee does. So basically, depending on how hazardous the job is and how much you pay the person, or basically what your total payroll is, because they're going to calculate your premium based on risk. And where do we decide? Well, how likely somebody is to get hurt on their job, and how much the insurance company is going to have to pay if they get hurt. So they look at those factors and they establish a premium, and then they will audit that at the end of the year. And if it turns out that what you paid was different than what you paid the prior year, what you anticipated paying, then there's a balance due. So, and this is again something that is paid entirely for by the employer. And what it costs again will depend on your payroll and the kind of industry. So, um, as it turns out, luckily, workers' comp for payroll, clerical, or for lawyers, clerical workers, really low. People like loggers and chimney sweeps, from what I understand, really high. And so here are the journal entries when you would make those workers' comp premium payments. And then once you have your audit done, if it turns out that there's an adjustment that needs to be made because what was charged and what you paid wasn't the same, then you've got to make an adjustment for the additional premium due, or if you overpaid and they're going to give you some money back. And I know this went a little long, but hopefully payroll isn't a completely foreign concept to you, so I thought I'd try and crunch it all into one video. But that concludes Chapter 9. Yay!